Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing National Health Investors stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. National Health Investors is a real estate investment trust, a REIT. Its real estate portfolio is valued at $3 billion. This is from 208 healthcare properties, which consist of 133 senior housing communities, 72 skilled nursing facilities, 2 hospitals, and 1 medical office building. In addition to that, it owns 14 mortgages and $290 million of notes receivables. The company is headquartered in Tennessee and was founded in 1991. It trades on the New York Stock Exchange and Deutsche Borse. Let's get started with the model. This is a mid-cap company, 2.5 billion market cap. They're trading at $53 a share, and they have 46 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. And free cash flow is cash flow from operations minus capital expenditures. So they have pretty consistent free cash flow each year, around $200 to $240 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's also pretty consistent each year, peaking in 2020 at $185 million. Revenue is the sales for the company, and that's around $300 million a year. The easiest way to value a company is when they have positive and consistent numbers. And it doesn't get much better than this. In order to try to predict the future, you need the past to be somewhat consistent and accurate. If it's all negatives or the numbers are all over the place, it's really hard to predict the future. That's why you call it an estimate. When the numbers look like this, the estimate is much more reliable. This is the company's income statement. The top line is the revenue, the sales. Below that is their cost of revenue. Since this is a REIT, their cost of revenue is really low. Revenue minus cost of revenue gives you your gross profit. And below that is their operating expenses. And then below that is their operating income, which was lowest in the trailing 12 months at $174 million. They have $1.3 billion of debt on their balance sheet. So they paid $48 million of interest on that debt in the trailing 12 months. And the bottom line of the income statement is their net income, which looks really good. And you see they don't pay any taxes. That's why companies apply to become REIT structures, so they can avoid taxes. But a REIT must pass on at least 90% of its profits in the form of dividends to the investors. This is how REITs avoid double taxation. So if a company pays taxes, say they pay 20-25% in taxes, that's less money that can go to you, the investor. Since they don't pay any taxes, there's more money left over to go to the investor as dividends. A normal company like Microsoft pays taxes, then they give their investors a dividend, and then we pay taxes on that dividend. That's double taxation. REITs and MLPs avoid double taxation. This is their most recent income statement from their latest 10Q. This is the first 9 months of 2020 versus the first 9 months of 2021. So their revenue went down from $252 million to $229 million. Most of their revenue is from rental income. So they buy the properties and rent them out to different companies. Some companies lease to buy, which means they lease the properties and eventually they become the owners. NHI provided 14 mortgages to tenants, and the payment on those mortgages also go into the REIT. That was $19 million. There are also some tenants who take on loans, like construction loans. The payments on those loans also go into this bucket. And NHI provides a loan, so they're receiving the principal and interest on that loan. REITs own a lot of real estate, so they're always passing through depreciation expenses. They had $61 million of depreciation. They pay $38 million of interest on their loans because NHI might not have all the money to buy a property, so they'll take a loan out. G&I are expenses of the day-to-day operations, such as payroll and rent. They had $24 million of loan and realty losses. This was mainly due to impairment charges on its real estate, so they decreased the value of some of their real estate and passed through a loss onto the income statement. They had losses of $2.3 million from equity method investments. This is their investments in other companies, but this is a non-cash item, so we'll add it back on the statement of cash flows. They had an accounting gain of $26 million on the sale of real estate, and it looks like they had a penalty for paying off debt early. That was $451,000. So their net income went down from $148 million to $105 million. This is their statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. And they don't have any capex, so operating cash flow equals free cash flow. And most of their free cash flow does go towards dividends. But if there's any left over, they'll pay down debt. But when they want to acquire new properties, they have to add debt or equity. They add equity every year, $82 million, $96 million, $34 million, and $78 million. When a company adds common stock, it dilutes the current shareholders. It makes their shares less valuable. And they also added debt in 2018 and 2020. They paid down $250 million of debt in the trailing 12 months. When they buy real estate, that goes into the investing section. And when they sell real estate, the cash goes into the investing section. So they had a cash outflow of $250 million and then $342 million. So it looks like they bought a bunch of properties in 18 and 19. And it looks like they sold some properties in the trailing 12 months. So they probably added $300 million of debt in 2018 to acquire some properties. They were able to pay down some debt because they sold some properties. This is their cash flow from operations section from their 10Q. First 9 months of 2020, first 9 months of 2021. The way to calculate CFO, you start with net income, then you have to add or subtract the non-cash items on the income statement, then adjust for changes in working capital. So we start with $105 million of net profit. We have to add back the $61 million of depreciation. We have to add or subtract the amortization. We have to subtract out $12 million of rental income. The reason we subtracted out rental income is because income needs to be accounted for on a straight line basis. For example, say they had a new tenant and they wanted the property for only 1 year. NHI said rent is $10,000 a month, so for 12 months that's $120,000. Since you just want to do 1 year, you have to pay the entire year up front. So NHI receives all that cash up front, but they can't book it onto the income statement until the year is complete. So they have to book $12,000 every month onto the income statement. In order to record the rent on a straight line basis, they have to adjust in the statement of cash flows. So that's why they had to minus out this $12 million. If you own a small business, you probably use cash accounting. You record cash as it comes in, which is much easier. But with accrual accounting, it could get a bit confusing because you can't record the cash when it comes in. You can only record it when the service is used or the product is delivered. Since they sold the property and had a $26 million accounting gain, we have to minus that out here because it should be on the cash flow from investing section, which I'll show you in a little bit. But the company needs to record all the income and expenses that occur in a certain period. All the rental income is part of their operational business, but their business is not to buy and sell real estate. So that's why we have to minus it out here because it doesn't belong in the operations section. Remember that impairment earlier? It was labeled loan and realty losses. Impairments are non-cash items, so we add it back on the statement of cash flows. It looks like they purchased something on credit in the past and they're paying for it now. So we have a cash outflow of $2.6 million accounts payable. Even though they reported $105 million of net income, they actually generated $158 million of cash flow. This is their cash flow from investing section and their financing section. When a company gives a mortgage loan out to a new tenant, that's a cash outflow. That was a cash outflow of $55 million. But when they collect on those mortgages, that's a cash inflow. That was $65 million. It looks like they acquired $47 million of properties, and they received $203 million from the proceeds from the sale of properties. They spent $3 million renovating some of their real estate. In the first 9 months of 2021, in the investing section, they had a cash inflow of $163 million. When they sold the property, the income statement reported the accounting gain, not the cash gain. Say you bought a rental property for $500,000 and you paid all cash, and then the following year you sold it for $500,000. When you sell it, it's a cash inflow of $500,000, but it's an accounting gain of $0. If you sold it for $600,000, it would have been a cash inflow of $600,000 and an accounting gain of $100,000. We really should take into account depreciation because the gain would be a little less. but I don't want to complicate things. We can do that in a future video. And in their financing section, they received $95 million from a credit facility. They paid down $393 million in that facility. They paid down $250 million on a term loan. They received $400 million in debt. They received $48 million from issuing common stock. When someone bought convertible debt from this company, say they bought $10,000 of convertible debt, they would receive a guaranteed interest payment on that debt. And when the debt matures, they would receive the $10,000 back. The only stipulation is if the stock price goes up a lot, then the investor can convert that debt to equity, and the debt would get removed from NHI's balance sheet. Apparently the stock price hasn't gone up enough for that debt to convert to equity, so the debt matured and they had to pay $66 million on that matured debt. That's a big benefit when investors inflate a company's stock price, is all the convertible debt converts to equity, and the company's balance sheet improves a lot because it lessens their debt. And they paid out $141 million of dividends to their shareholders. I don't know if they have any preferred shareholders, but this would include common and preferred shareholders, not just common shareholders. In their financing section, they had a cash outflow of $317 million. This is the equity section on their 9/30 balance sheet, and they have $1.5 billion of equity. They raised $1.6 billion from selling their business, and they have a net loss of $49 million from running their business. This can happen a lot with REITs since they pay so much out in dividends. This negative $49 million is the sum of all their prior net incomes minus the sum of all the dividends they paid out. But as you know, the income statement is artificially pushed down due to depreciation. So they're probably cash flow positive, but they have accounting loss historically. In the long run, they need to have an accounting profit or they're going to have to go bankrupt. Let's look at the capital structure. They have $1.5 billion of equity, $1.3 billion of debt. They're 54% equity, 46% debt. And I gave them the highest whack on Finbox, 7.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's $5.7 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $5.1 billion. We divide that by 46 million shares. And we get a calculated stock price of $112. They're trading at $53, so they're trading at a 52% discount. It's a really strong buy according to the model. The average analyst projects their revenue to grow 7.7%. I grew their revenue 7.7% for the next 4 years. That's how I calculated their future revenue estimates. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers, I divided by these 4 revenue numbers. And that comes out to 71%. So they convert 71% of their revenue to free cash flow. So I multiplied their future revenue estimates by 71%. That's how I got their future free cash flows. REITs have really high margins because they don't have that much expenses. They don't have many workers. They're not building products. They're just making sure the properties are maintained and collecting rent payments. Simply Wall Street is even higher than me. They're at $172 a share, so they're saying the stock is 69% undervalued. When you invest in a stock that pays a dividend, and the higher dividend they pay, there's less stock price appreciation. Because if the company pays a 5% dividend annually, the stock price has to go down at least 5% to account for the dividend payment. 4 analysts priced this stock and the average price target was $66. This is where the stock has been trading the last 2 years. Before the Corona crash, it was over $90 a share. And then it really crashed. It fell off a cliff. It has come up since the bottom. It was close to $75 a share at one point. But in the past few months, lots of stocks connected to real estate have struggled. And the reason most people invest in REITs is for the dividend payment. The dividend is close to 7%. And they have lowered their dividend payment. They were paying $1.10. Their payout ratio is over 100% because of all the depreciation it brings down their net income. But the dividend comes out of the free cash flow. It's better to look at dividend over free cash flow than the payout ratio. And that's 77%. And they pay a much higher dividend than their industry. And analysts are projecting them to grow their dividend to 7%. Their beta is close to 1, so the stock moves with the market. It's gone down 19% in the past 52 weeks, while the S&P is up 23%. The 52-week low was 51, the high was 79, and the stock is trading below its 50-day and 200-day moving average. 300,000 shares are traded each day on this stock. Of the 46 million shares outstanding, 44 million are on float, 66% are held by institutions, and 3.5% of the shares on float are shorted. And they don't need many employees. They only have 20 people working at the company. If you put $10,000 into this company 10 years ago and reinvested the dividends, you'd have $22,000 today. That's an 8% annual return. A good sign is when insiders of the company are buying the stock. And there's been lots of insider buying the past year. And it doesn't seem like any insiders are selling. 4% of the company is held by insiders, 32% by the general public, and 64% from institutions. Vanguard is the biggest shareholder at 14%, then BlackRock, State Street, Macquarie, and Goldman. Let's look at their financial ratios. They have a good PE of 17.2. Their price to sales is 7.9, which is between the market median and average. And they have a pretty good price to book of 1.6. They have a low ROIC of 5%. They can cover their interest payments 3.5 times. They have a pretty high ROE at 9.3%. And they have a high current ratio and quick ratio of 6.5. So they seem to be well capitalized. They generate $213 million of free cash flow in the trailing 12 months. They have $381 million of working capital, and they paid out $165 million of dividend payments. So they have over $400 million of funding. When you look at a REIT, it's better to look at price of stock over funds from operations per share, as opposed to the PE ratio. Funds from operations is net income plus depreciation and amortization minus the gain on the sale of real estate. And they have a really good ratio of 11.3. The lower the better for this category. And the average is 14. Their PE is better than average. Price to sales is worse than average. Price to book is pretty much average. They have a high current ratio. They're pretty close to the average in ROE. They're better than average in debt. And they're on the smaller side, 2.5 billion market cap. The average is 9 billion. But their dividend is really high, one of the highest in this industry. So to summarize, I have them trading at a 52% discount. And this seems like a fairly secure dividend. So you shouldn't expect too much price appreciation since they pay such a big dividend. Although the stock price has been cut in half the past few months. So you may hit the jackpot on both ends. A higher stock price and a high dividend. But the market has been really struggling the past couple of weeks, so who knows what's going to happen in the future. I rank their free cash flow 6 out of 10, their revenue 6 out of 10, and their ratio 6 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.